Okay, so very good afternoon, everyone, and a very warm welcome to our last sprint on CMA Part 2. Right, so today on agenda we'll be looking at Part 2, Section E, which is investment decisions, and then we will close the day with Section F, which is the section on professional ethics. So we're going to have a pretty exciting class today. And I hope all of you are all set. Of course, we had a week break in between. I hope all of you have used that to cover any backlogs, and I'll have more front benchers in the class today. So somebody says, Aniket says, sad. No, I think Aniket, all good things come to an end. And, with this, I'll leave you after this week over the next couple of months to practice. Look at the CMA Part 2 class, Part 2 exam in the month of January before a lot of you come back for Part 1. So give me a second. So, okay, so just change some volumes. Okay, great. So Shivansh is already got the COVID vaccines and all. Very nice. So I think welcome everyone on the class. I think all of you deserve a round of applause. So let's do this, right? That we do every time. Let me unmute everyone and let's give it up for everyone in the class. So here we go. Okay. So let's start with a couple of customary polls, and then we will immediately hit the ground running. Okay, closing the poll now. Okay, I think I closed the poll a little too early, but fair enough. I think we have this, and a quick third poll. I think this is the most important poll. Just to check. Okay, what's your status so far on A, B, C, D? We've come a long way, guys. A, B, C, and D. Okay, so closing this. Yep, Aditi, yes, this is only for the MCQs, which is there on the Miles LMS. And I know that's a few number, but we at least expect you to do all of that week on week. For November and December, we'll expect you to spend a lot of time on the Wiley, online access before you look at the exams in the Jan-Feb window. Okay, so about 23% front benchers in the class, 17% back benchers, and guys, all of you, with this last class, need to up your game. Everyone needs to up their game to make sure that you are absolutely sorted, for the CMA exam for the Jan-Feb window. So I think, round of applause for everyone once again. And with that, let's get started. So Section E, is about investment decisions. So let me ask you this question. When you decide to make an investment, how do you analyze? How do you decide which investment, which project or which opportunity to go after? Before you take a decision for various investment opportunities, how would you decide which opportunity to go after? And I see a lot of people saying, okay, hey, returns, we say ROI, return on investment, right? And then we're going to look at a lot of capital budgeting techniques today in the class. Now, before we sort of delve deep on investment decisions, a quick question, for all of you. And this is about money, right? Or time value of money. Let us say I give you a couple of options. Option number one is I'm going to give you $100 today. Option number two, I'm going to give you $100 after 1 year. Which one will you go for? Okay, everybody wants that $100 today, right? Okay, so the point is, right, you know, because $100 today is going to be worth more than $100 in a year's time, right? Time value of money. Money grows with time. Okay, let me put it this way. Now, if I were to change my options and I say I'm going to give you a $91 today or $100 after 1 year, and let's assume that the rate of return is 10%, right? So 91 today or 100 after a year. Now, perhaps you'd be indifferent. You'd be okay with anything. You'd be okay with either a 91 today or 100 after a year, right? So the point is, what we are saying is, $91 today is going to be worth about $100 in a year, or $100 after 1 year, that is worth 91 today. In other words, the present value of $100 after 1 year is $91. Everybody with me on this? Now, just so that everybody sort of gets a good feeler on present value, let me quickly run you through a few present value tables, right? So if you look at the first table, we're talking about a present value of $1. Look at the first column. It talks about number of years. That's basically money coming in after 1 year, 2 year, 3 years, 4 years, 5 years, and the various rate of return. So just to keep it simple, let me assume we are looking at a 10% rate of return. So let's say we're looking at 10%. So let's talk about this, right? So when we say you're going to get, let's say, $100 after 1 year, the question is, how much is that $100 worth today? So 100 into 0.909, so that $100 after 1 year is going to be worth 90.90 today. Now, if I tell you there is $100 which is coming after 2 years, how much will that be worth today? $100 after 2 years, 0.826. So that's going to be worth 82.60 today. But if I tell you there's $100 coming in after third year, 3 years, how much is that worth today? $0.751, so 75.1. $100 after 4 years. That's going to be worth 68.3 today. Or $100 after 5 years. $62.1 today. Everybody with me on this? Okay, now if I tell you, okay, hey, there's going to be a series of cash flows of $100 each year for the next 5 years, right? So we're talking about a series of cash flows, $100 each year for the next 5 years. What would you do? You would do a summation of all of this, right? So can you do a sum total of this, guys? So this is about 379 or 379.1, whatever that is. I think 379, right? So if I do a summation of all these 5, it's 379. Now, instead of doing this entire thing, I could jump on and look at the present value of an ordinary annuity table, go on the 10% return, look at the 5 years. So when you say annuity is a series of cash flows, same number each year, right? A series of similar cash flows. So if you get $100 each year for the next 5 years, the present value of that today, I mean, of course, you could calculate the present value of all the $1s and look at the 379 sum total, or you can directly jump on here to 379.1 and you say 100 into 3.791, that's going to give you 379.1. Everybody with me on this? Or let's say if we talk about a series of cash flow for 3 years, let's do 3 years, right? So year 1, year 2, year 3, so 3 cash flows. Then we do 90.9 plus 82.6 plus 75.1. Can somebody do that? 90.9, 82.6 and 75.1. That's going to be 248.6. If I look at this, I get the similar number, 2.487. So 248.7. I mean, there's some rounding errors, but the point is, if you have a series of cash flows, instead of calculating the present value of each cash flow, you can look at an annuity table. Everybody with me on this? Amazing. You guys are very, very smart. So in other words, the moral of the story is money grows with time. Everybody gets that? Money grows with time. That's the moral of the story. And now that we've got our basics in place, I'm going to quickly spend a little bit more time, run you through a piece on cash flows, and then we immediately hit the ground running with capital budgeting techniques. Okay, so let's look at this. Yeah, one yes, the percentage would be given, right? I assumed 10%, it could be 9%, it could be 8%, it could be 12%, whatever. I assumed 10%. Okay, so let's now look at a method of calculating cash flows. So what you see here is, we have sales. It's the sales of $1,000. And then you have costs other than depreciation, interest, and taxes of $600. That gets you to when you're doing cash flows. Typically when you're building up cash flow models, you would often come across this term called EBITDA. So guys, EBITDA, what does it stand for? Earnings before interest, taxes, depreciation, and amortization. Everybody good with this? EBITDA, earnings before interest, taxes, depreciation, and amortization. All right. So EBITDA here is 400. Now from EBITDA, if you remove the da, what are you left with? EBITDA. Take the da off, you get EBIT, right? So if you subtract depreciation and amortization here, you will get to EBIT, which is $300. Now from EBIT, if you subtract interest, you would get to earnings before taxes, EBT. And from there, if you subtract taxes, you get your net profit, your net income, or you can call it earnings after tax. Everybody with me on this? Okay. One of the important pieces that you need to understand whenever we're looking at cash flows is we're looking at how much cash is actually going out, right? Now, one of the anomalies here is the piece on depreciation and amortization. Is think about how depreciation works. Let us say, you bought a machinery and equipment for $500,000, right? And then machine has a 5-year life. And let's assume zero salvage. How much will you depreciate each year? $500,000 machine. You have $100. So $500,000 machine, a 5-year life. How much do you depreciate each year? Like $100,000 each year, right? So you're going to depreciate like $100 each year, $100,000 each year over the next 5 years. So think about it, right? When you buy the machine, do you think the machinery supplier would be okay if you tell him, I will pay you 100 per year for the next 5 years? The machinery supplier would want the entire $500,000 the moment you buy the machine. So your cash outflow is happening on day one when you're paying out the entire $500,000. Then over the next 5 years, you will depreciate 100 each year. But when you depreciate 100 each year for the next 5 years, you're not actually paying out cash. Everybody with me on this? So what we are seeing is in the subsequent years, when you depreciate, let's say 100 per year, there is actually no cash outflow. The cash outflow happened once you bought the machine, not every year over the next 5 years. That is where when we calculate cash flows, we add back depreciation. Look at this. We add back depreciation. Everybody clear? So depreciation is for fixed assets. Amortization is for intangible assets, like, let's say patents, right? Like copyright, right? You're going to have amortization there. So what we are doing is because depreciation is a non-cash expense, you're not actually paying out cash every year for depreciation. That is why to calculate cash flows, you add back depreciation. So guys, if you look at in this example, the earnings after tax was 175. You add back 100, your cash flows is 275. Everybody with me on this? Now I see some people really perplexed. They're like, okay, if we had to add back depreciation, why did we even subtract it? Anybody? I know a lot of people have this question. If we anyways have to add it back, why did we even subtract it? Okay, so let's look at it. Let's do a different way, but let's not add it back, right? So let's say let's not subtract it. So 1000 minus 600. Let's say EBITDA is 400, right? And let's not subtract depreciation. So in that case, EBIT would be 400. So let's say we get 400 here, and from here we subtract the interest. So we get 350. Now on this 350, guys, if I have to calculate tax at 30%, how much will that be? 30% of 350? So I have not subtracted depreciation. How much do we get? 350 minus 105? So cash flow is 245. Okay, wait a minute. Why is there a difference here? Why is this 245 and this one 275? Well, the only difference between the two is in the second way, in this new way, I have not subtracted depreciation. Okay, I see a lot of people saying the tax shield on depreciation. So guys, something you need to understand is when you expense depreciation, this helps you reduce your taxes. Look at taxes here, it's 105. But if you reduce depreciation, the tax is only 75. So basically what we are saying is the $100,000 depreciation expense, though it is a non-cash expense, the depreciation expense is helping you reduce your taxes by $30. Everybody gets this? Because the moment you expense depreciation 100, your tax liability reduces by 30. So it helps you save $30 in taxes. Because taxes you would have to pay in cash. So it helps you save $30 in taxes. And that is what we call a depreciation tax shield. So guys, this one is wrong. So what you do is you subtract depreciation, right? Calculate the taxes, you get your net profit. This one's net profit. On your net profit or earnings after tax, simply add back the depreciation, you will get the amount of cash flows. Everybody's getting this? Amazing. You guys are rock stars. Very nice. Very, very nice. Okay. So let's do this, right? Let's get to a couple of capital budgeting techniques, right? Let's look at this situation that we have here. So let's look at this. It says assume an investment of $300 results in a return of $100 each year. In the first 5 years. So you invest $300 and you get $100 every year. What is the payback period? You invest $300 and you're getting $100 each year. If I ask you, what is the payback period? So can I say the formula for payback period is the amount of investment which is done divided by the annual cash flows. And in this case, of course, it's easy because the annual cash flows are the same number. So your investment is $300. You're getting $100 every year. So in 3 years, you will recover your initial investment. Everybody gets this? Okay. Now the only challenge here in this payback period method is, if you realize we are ignoring the time value of money. Let's say, we talk about $100 after 1 year. Today's worth of that is, let's say, less than $100, maybe about $91. $100 after 2 years, today's worth is, and the $300 investment, that's happening today. Now, that is where we will use another method, which is the discounted payback period, discounted payback method. So let's calculate payback as a discounted payback period. So here, guys, if you look at this, right? So we're talking about cash flows coming in after year 1, year 2, year 3, year 4, and year 5. And you're getting $100 each year. This is year, this is amount, $100 each year. Now, the point is, what is the present value of each of the cash flows? So if you're getting $100 after 1 year and the interest rate is 10%, how much is $100 after 1 year worth today? 90.9. If you're getting $100 after 2 years, how much is that worth today? 82.6. Third one would be 75.1. Then you have 68.3 and 62.1. Everybody good with this? Now, when we calculate the normal payback period, we are looking at this one, 100, 100, 100. In 3 years, the investment is recovered. But we don't consider time value of money there. Now that you're doing discounted payback, we're going to look at this one. If you realize at the end of first year, we have recovered 90.9. At the end of second year, we have recovered 82.6. Guys, how much is the cumulative present value? Sorry. Cumulative present value. By the end of year 1, 90.9 is recovered. Year 2, 90.9 plus 82.6. 173.5 plus 75.1. 248.6 plus 68.3. 316.9. So guys, if I look at this, the $300 recovery is happening somewhere here, somewhere between year 3 and year 4. Because if I'm looking at, the discounted numbers, it's very clear. By the end of third year, I've not recovered 300. I've only recovered 248.6. How much is yet to be recovered? If I've recovered 248.6, yet to recover is 51.14. Okay. Yet to recover is 51.4. Now in year 4 overall, how much is the recovery in year 4 overall? 68.3. Now, if in an entire year I recover 68.3, how much time in the year will it take for me to recover 51.4? Yes, can you do a 51.4 divided by 68.3? It's 0.75. So basically, we're talking about, for recovering 300, we need 3.75 years. Or in other words, 3 years, 9 months. Everybody gets this? So if I look at normal payback without present value of money, right? Without time value of money, done in 3 years. But if I look at discounted payback period, it's longer, right? Because, what we are saying under the discounted payback is that, okay, hey, though you are, recovering $100 each year, the $300 is going out upfront. Okay, somebody says how 9 months? Okay, guys, 0.75%, 75% of 1 year is 9 months, right? 1 year is 12 months. So 0.75 into 12 is 9. Somebody's asking, how did 51.4 come? Okay, so we have to recover 300. By end of 3 years, we have recovered 248.6. So 300 minus 248.6 gives you 51.4. Everybody got this? Is simple, easy stuff. And I think all of you deserve a round of applause. Everybody's getting this. You guys are ready for a poll question? See, lot of readiness. I see yeses with so many S's. Okay. Okay, let's see. So guys, a couple of things here on this question, like NPV and IRR, which I've not covered so far, but I want you guys to start working on it. And then of course, we will do this in a lot of detail. So once you respond to this, we'll spend a lot of time. Let's get some action in here. Okay, guys, I'm going to close the poll now. Make an informed guess. Okay, let's see what we've got. Okay, so this is a buddy company. It's considering the purchase of a machine, and they've developed the following budget information. So the saying is cost of the machine is $900, right? And then machine is going to have a useful life of 5 years. salvage value is 0, and depreciation is straight line. Is everybody clear? The annual depreciation is going to be 180. Everybody okay with that? Annual depreciation is going to be 180. 900 divided by 5 years. Now the net cash flow, annual net cash flow is 250. Because if the annual net cash flow is 250 and depreciation is 180, how much is the accounting profit? So we saw that, right? The accounting profit, net profit plus depreciation is cash flows. So if cash flows is 250, this is 250, and this one is 180. So minus will be plus, right? This one is 180. Net profit will be 70. So we talk about accounting rate of return. You're getting 70 bucks each year. The return is 70 bucks each year. Investment is 900. So what's your rate of return? Simple, easy. Most of you got this right. Amazing. Okay, let's talk about payback period. So payback is basically investment by the annual cash flow. Investment is $900. Annual cash flow is $250. So how many years for you to recover 900? You've paid 900 now, you're getting 250 every year. How long will it take for you to recover back then? 3.6 years. Everybody clear with this? Amazing. Very nice. And most of you got this right. Okay. The next thing is calculating the NPV, the net present value. Now, when we talk about NPV or the net present value, what we have to look at is we have to look at the present value of inflows and from that we will subtract the present value of outflows. Everybody clear with this? Present value of inflows minus the present value of outflows will give you net present value. Now, what is the present value of the cash inflows here? How much cash inflows are you going to get? $250 per year for the next 5 years. What's the gross cash inflows? 250 into 5, that's 1250. The gross cash inflows, if I don't look at present value, 250 into 5 years, we'll get $1,250. But guys, the present value will be lesser. Everybody agrees with that? The present value will be lesser. So for 5 years at a 10% rate, the factor is 3.79. So instead of 5, we will multiply it by 3.79. How much do you get? 250 into 3.79. You get about 947.5. So present value of cash inflows is 947.5. What is the present value of outflows? How much money going out? Is $900. And how much, when is the $900 going out? Today, right? So present value of $1 today is $1. So present value of inflows is 947.5, outflows is 900. What is the net present value? $47.5 or about $48. So guys, basically what we are saying is, if the NPV is positive, it's a very good sign, right? That means the present value of inflows is more than outflows. That means we are getting more than we are investing. And we've anyways taken the hurdle rate of return. Guys, hurdle rate of return generally is the cost of capital. And we spoke about that in section B, right? So the NPV is positive. That means the rate of return is more than 10% or less than 10%, guys. If NPV is positive, that means the rate of return is equal to 10%, more than 10%, less than 10%. Yes, that is what we call the IRR, or internal rate of return. Let's do that on an Excel. So if you look at it, how much is the cash flows in this case? Let's build out the cash flows. $900 going out right now, and then $250 coming in every year for the next 5 years. Everybody okay with this? Now let's calculate IRR here. %. Everybody with me on this? The IRR here is 12%. Everybody cool with this? So let's do something interesting, right? Let's take what if the hurdle rate of return given to you was 12%. What if this was 12%? If this was 12%, on this table, you would have gone to 12% here. And look at 3.6. Somebody's asking, Sonam is asking, what is hurdle rate? Hurdle rate is the expected rate of return. The cost of capital, the expected rate of return. The company is expecting 10%. Now, if the company was expecting 12%, then if we were to calculate NPV, what will be the present value of inflows? $250 multiplied by 3.6. How much will that be? 900. 900 minus 900 is 0. So what we are saying is, at the point of IRR, NPV is equal to 0. In other words, if IRR is equal to the hurdle rate, the NPV will be 0 at that point. But guys, in this example, if you realize, the hurdle rate was only 10%. Whereas this project is giving us 12%. The IRR is only 10%, but this project is giving us 12%. So it's giving us more than expected. So it's a good project. Everybody with me on this? Now I see a lot of you worried. Okay, how do we calculate IRR if Excel is not there? Okay, let me give you a technique to calculate IRR if Excel is not there, right? Everybody remembers the formula of payback period? What is the formula of payback period? Everyone, what's the formula of payback period? So payback period is investment by annual cash flows. Okay, let us use the same formula to calculate IRR. Investment by annual cash flows will give you 900 by 250. That gives you 3.6. Let us try to find this 3.6 in the 5-year annuity table. Okay, 10% is 3.79. 11% is 3.7. Is 12% is 3.6. Everybody gets this? Everybody okay with this? Okay, now let's play around with this. Let's play around with this a little bit. 1 second. What if the annual cash flows was not 250? Let us say it was, let's say 900. Let us say the annual cash flows was $240 every year. If the annual cash flow was $240 every year, I'm just trying to create a new situation, then payback would have been 900 divided by 240. How much would be this? 3.75. Now, if I look at the present value table, 3.75 is somewhere between 10 and 11. Give me a second, guys. Give me a second. Okay. Somewhere between 10 and 11. I think Prajapati has a question. How did 240 come? Prajapati, I'm just trying to create an iteration on the example. Is there a problem with that? So let's look at this, right? So so if the annual cash flows instead of 900 was 240 per year, and let's say we have to calculate the IRR. Look at this. So the IRR is 10.42%, somewhere between 10 and 11. Everybody with me on this? So naturally, when the cash flows are reducing, the IRR comes down. IRR is lesser. Everybody with me on this? Okay, we can take another example, another very simple example. Let's say the annual cash flows was, let me just look at this. Let's say about 255 per year. Annual cash flows was 255 per year. How much would be the payback period? If this was 255, this would be about 3.52. So the payback period would be approximately 13%. Everybody sort of gets this? No, this is not the perfect method, but sort of gets you a way of how you can use the payback period formula to calculate IRR. Of course, in the given example, we have 3.6 years. So I only need to find 3.6. I find it at 12%. Everybody good with this? So in this example, if can I say that the rate of return of the project, the IRR of the project is higher than the hurdle rate? The expected rate is 12%. The IRR is 12%. Expected is only 10%. So this is giving you more than expected. So we should accept the project. Or also the NPV is positive. The moment NPV is more than zero or more, again, we should accept. Because if NPV is positive, that is very clear that IRR is more than the hurdle rate. If NPV is equal to zero, we would say IRR is equal to the hurdle rate. Everybody gets that? Okay, now Tushar Gupta has asked a question 2 times. Now, if I don't answer it, he will ask it another few times. So Tushar has a very interesting question. He says, what in case of uneven cash flows? The example that I've given you here is same cash flows every year. What if you have uneven cash flows? Okay, in that case, Tushar, use Excel. Everybody with me on that? So if you have uneven cash flows, then the formula will not work. Then you use Excel. Everybody clear? In exams, they won't really put you in that spot because they don't give you Excel on the exam. So on the CMA exam, they will not put you in that spot. Okay, any other questions? Okay, so guys, hold on. Everybody sort of gets the basics here. Okay, amazing. First round of applause for everyone. Are you ready for a poll question, everyone? I see an interesting question. How can we attend offline classes? The easy response for that question is by coming to class. You can either walk to class, you can take a bus, you can drive, take an Ola, a bike. I mean, we can also arrange helipads. I mean, okay. Okay, so okay, so okay. Everyone done with this? When I put a poll, I see a lot of questions coming on the chat. So instead of responding on the poll, you're more worried about asking the question in the chat box. Okay. So guys, the point is, just go on the Miles website. You will see the schedule for the offline classes that we have. Here we go. So these are the schedules for offline classes that we intend to start from November. The way this would work is you have let's say Bangalore classes starting in from 13th. Guys, these are for part 1. So frankly, I'm not expecting any of you to be coming back for part 1. You guys should actually pass the CMA exam for part 2 in Jan and then come back in the month of February. So that's what my that's what my recommendation would be. But in case you're attending part 1, so if you look at the way the online classes are, the live classes are structured, is from November 13th onwards, we will have 2 sessions on Saturday, and Sunday morning for 3 hours we will have a face-to-face practice session, and then the same online sessions will continue. Everybody gets that? So Lokam, Shri Harsha has an interesting question. Will I be coming for the live classes? So Lokam, let's look at this, right? So we're having live classes across 9 cities. And let's say, all the cities, the live classes are happening at the same time. What do you think? Okay. If you have any strategies for me to be available in all the places at one go, would be more than happy to execute that. But of course, I'm still going to be taking the first classes, the morning class, and then of course the Miles faculty team would be taking care of the remaining pieces. And somebody says Jadoo magician, so the magic can happen for a few things, but of course 9 locations, and we also have classes in Dubai happening. So you can look at the schedule. So guys, the agenda is, we're not doing a lot of face-to-face classes. It's going to be about 3 hours every week. But we'll sort of scale up the offline classes over a period. The online would still remain. So what we're doing is going forward, and we've seen a very, very good pass rate, a very good result during the entire COVID period. So we're going to continue with the online mode. On top of online, we will add a few offline classes as well. So people who want to do only online are fine. The rest can do a blended learning mode, which is online and offline. So perfect. Anyways, guys, you guys are distracting. We'll take the questions towards the end of the class, right? Can we focus on the poll? We have a lot of suggestions coming in, live statues. So I think we'll have to get in touch with AI engineers and create robots who can teach. In any case, okay. So what we have here is a multi-period project has a positive NPV. Okay, now look at this. KR has a question. Why do you shake your legs so much? Now, KR, come on. So for me, I love to be jumping around the class, walking all over the place, and on this webinar I'm made to sit on a chair and deliver this session. So I'm just trying to keep myself active, and I don't know, some people also have a problem with that. And KR is observing me. He's fully saying, okay, hey, there's some shake which is happening. Okay. Amazing. You guys are, I mean, you should be a psychiatrist, instead of a CMA student. Okay, anyways. Okay, and look at this. I have some people really supporting me. Kona says shaking legs is good for a healthy heart. Amazing. You guys are rock star. I mean, I'll really miss you guys. I mean, I think Kanti, round of applause. Okay. Okay, so amazing. So let's come back to the poll question. Rahul says, I also nod my head. Amazing. Guys, it's like, you fully know what I do. You can read, if I were to play poker with any of you, I would lose, because you guys can read me. But in any case, guys, let's focus on this. Okay, a multi-period project has a positive NPV. Guys, a positive NPV is a good thing or a bad thing? Positive NPV is a good thing, right? So now, if you were to invest in a project, what would you expect in a good project, in an exciting project? What would be higher, the IRR of the project or the required rate of return? So if the NPV is positive, let's say you have in this question, right? The NPV is positive. The NPV is positive. That means the IRR is more than the required rate of return. The IRR here is 12%. Required rate is 10%. That means IRR is greater than the required rate. In other words, the required rate will be less than the IRR. Guys, come on. Simple English. In this project, which has a positive NPV, naturally the IRR is greater than the hurdle rate, or if I rephrase it, if IRR is greater than the hurdle rate is less than the IRR. What's the right answer? B. And guys, 79% of the class got this wrong. Everybody gets this, right? Very, very simple question. Very simple question. It's just that instead of numbers, it's got words. Everybody clear with this? So the question says, which statement is correct regarding its required rate of return? You guys seem to be playing like India playing Pakistan. I mean, come on, we need to do better. Okay. So, the right answer, of course, is B, less than the project's IRR. Of course, D is wrong. Because it's the other way around. Normally, guys, when you talk about required rate of return, let's say in this example that you have on the slate, the required rate of return, the hurdle rate of return is 10%. Generally, the required rate of return is the company's cost of capital. Generally, the required rate of return is the company's cost of capital. So therefore, A and C is wrong. The required rate of return is not less than the company's WACC. It is not greater than the company's WACC. It is generally equal to the company's WACC. Generally. Everybody clear with this? Right answer, option B. How does it feel, guys? Okay, let's have a round of applause for everyone. I think all of you tried hard. So what if you lost the match? Okay. Do you guys want another one? Easy one, difficult one. Okay. So let's do India versus New Zealand now. Okay. Somebody, Ishwarya just did a grammar mistake. Okay. It costed you heavily. Okay. Chris says give a bouncer. Okay. Let's see. Let's see what we have. Soham says we'll win tomorrow's match. Soham, first thing, let's win this question first. Okay, guys, I'm going to close the poll now. Because everybody can make an informed guess. Okay, so we seem to have a divided house here. So let's see this, right? So let me do this using Excel so that everybody really understands this. This is a very interesting question, guys. This question would really help you get to the bottom of understanding IRR. So guys, let's look at the same numbers that we had on the example that we just did. Everybody good with this? IRR is 12%. Okay. Now, what is the payback period on this example, guys? What's the payback period? Okay. So payback period is 3.6. Let's do one thing. Let's shorten it to 3 years. Right. So 900 bucks in 3 years. Total was 1250, right? Total cash flows here was 250 into 5, 1250. So let me do this. Is equal to 1250 minus 900. Everybody good with this? Total is still same, 1250. What will happen to IRR? It will reduce or it will increase? Because if you are getting money faster, it's a good thing or a bad thing? if you're getting money faster, it's a good thing or a bad thing? Good thing. Then IRR will increase, right? Guys, look at this. 46% of the class is clean bold. C is absolutely wrong. Everybody gets this? If you shorten the payback period, money is going to come sooner. IRR will go up. It's a good thing. Everybody with me on this? And some people are really upset at me. Some people are really, really upset. Okay. But everybody getting this. I don't care if you're upset, but as long as you're getting this. Okay. Now let's look at the next one, right? A lot of people says decrease working capital requirement, decrease. Let's say these are the cash flows, 250 and over 5 years. If I tell you that initial investment, instead of making 900, you only have to make 800. Is that a good thing or a bad thing? It's a good thing, right? If you have to invest less, what will happen to your IRR? Go up. Everybody gets this? C is wrong. B is wrong. We're left with A and D. Okay, let's look at the other one. Use accelerated Okay, so let's talk about this. Use accelerated instead of straight line depreciation. So guys, everybody agrees that depreciation is a non-cash item. So depreciation will not really change your cash flows, except for the fact that depreciation helps you get tax benefits. Now, if depreciation is higher, then the tax benefit will also be higher. If depreciation is lower, tax benefits will be lower. So guys, if you were to use accelerated instead of straight line, what will happen is over the 5 years, the total depreciation amount will remain the same. But initial years, depreciation amount will be higher. Everybody agrees? If I use accelerated instead of straight line, initial years, depreciation amount will be higher. If depreciation amount is higher, tax savings will be higher in the initial years. It will reduce your taxes. So it becomes something like this. In the initial years, you'll get 275, 275. Later, you'll get 225 and 225. Just putting some random numbers. Total is still 1250. Everybody with me on this? If you use accelerated, the amount of depreciation in year 1 and 2 will be higher than year 4 and 5. Total depreciation would remain the same. But in year 1 and 2, it will be higher than year 4 and 5. So in year 1 and 2, or you will have something like this, right? I can say, 270, 260, 250, 240, 230. Total is still 1250. Everybody agrees with this? Cash flows. What will happen to IRR now? It will go up, it will go down. It will go up, right? You're getting money quickly. You're getting money faster. Look at IRR. Again, just sort of, it still go up. It's still there, but let me just change number 290, 270, 230, 210. Clearly shows out. Everybody with me on that? So B is wrong, C is wrong, and D is wrong. 81% of the class has gotten this wrong. The right answer, of course, is option A. Let's work on that. Okay, when we say tax credits, what do you mean by tax credits? Think of tax credits as subsidies, benefits that the government is giving you, right? So let us say if you buy an asset, let's say this machine is an environment friendly machine, and let's say the machine costs you $1,000, and the government is giving you $100 10% subsidy. So the net cost of the machine is 900. Now let us say the government decides to reduce the tax credits. Instead of giving 10%, they are saying they will give you 5%. How much will be your initial cash flows? Your IRR will reduce. Everybody clear with this? Tax credits are tax benefits. If the government is reducing tax benefits, it's a bad thing. Everybody with me? If the government is reducing tax benefits, it's a bad thing. Your IRR will reduce. Everybody gets this? Amazing, amazing. Everybody's gotten this. Nice. Very, very nice. So how does it feel, guys? Are you guys feeling more confident now? Somebody said confused. Okay. Okay. Some people want a break. Okay, so let's do this. Let's take a 15-minute break now, and let's resume back at 3:35. Everybody good with this? Somebody said one more explanation. Please, the question is asking you, right? Just to explain you once again, the question is, what is the question asking you? Look at this. The question is asking you, what would decrease IRR? Decrease IRR means what's a bad thing? Everybody agrees? Decrease IRR means what's a bad thing? Decrease in IRR is a bad thing for you, right? In case of A, tax credits, these are tax benefits given by the government. So the government says, if you buy this machine, I'm going to give you certain tax benefits. If you get tax benefits, let us say, what I assumed is for $1,000 machine, you're getting $100 tax benefit. Now the government says instead of $100, they will give you $50 tax benefit. The moment they say they are reducing the tax benefits, it's a bad thing, right? Everybody gets this? A decrease in tax credits, a decrease in tax benefits is a bad thing. So IRR is reducing. But option B, C, and D are good things. In case of B, your working capital requirement is reduced. It's a good thing. Your payback period is shortened. It's a good thing. Using accelerated instead of straight line. Again, it's a good thing because, again, this will help you shorten the payback. So in case of B, C, and D, your IRR is going up. In case of A, the IRR is going down. Everybody gets this? Amazing, amazing, amazing. So round of applause. Okay. So let's do this. Let's extend the break a little bit. Guys, we'll resume back at 3:40. So we'll resume back at 3:40, and we should be done with the class pretty much on time. I think, my agenda on the class was to get you started on this, very exciting topic. And once we come back, I'm going to shoot a couple of polls at you, and then we will get you professional ethics. So, hopefully we should be able to wrap up the class before 4:30 today. So let's see how we progress once we are back. So guys, resume back at 3:40. Cheers, guys. Okay, guys. So we are back. So before the break, we got started with the various capital budgeting techniques. I think we had a good flow with the NPV and the IRR piece. And of course, a couple of polls where A lot of you, got bamboozled. How about we start with another poll, guys? What do you think? Are you ready for another one? Okay, so we have a lot of yes-sayers. Okay, amazing. So let's do this. Okay, closing the poll now. There's no negative marking. Tricky or not tricky, everybody should respond. Some people choose not to respond. So let's see. Okay. What is the primary caution when using a company's cost of capital as a discount rate to evaluate a capital project? So let's talk about this, right? So normally a company has a single cost of capital. Let's say the cost of capital for a company is, let's say, 10%. Done? So a single cost of capital. We did the weighted average cost of capital back in section B. Everybody cool with this? So cost of capital, let's say, is 10%. Now we have, let's say, a high risk project and a low risk project. Okay, generally a high risk project will give you a higher return or a lower return. Let's say let's say the high risk project is giving you a 12% return, and a low risk project is, let us say, giving you, or let's say a high risk project is giving you 11% return. A low risk project, let's say, is giving you 9.5% return. Everybody good with this? So the IRR here is 11%. The IRR here is 9.5%. So if your cost of capital is 10%, and basis what I've taught you so far, which project will you go for? High risk or low risk? High risk project, right? Because we are just looking at the percentage. This 11% is more than 10%, so I will accept this. 9.5 is lesser, so I will reject this. So what I'm doing for both these is I'm comparing versus 10%. I'm using this 10% and just comparing. So this one is accept, this one is reject. Everybody agrees with this? So option A says evaluation typically rejects high risk project. No, evaluation typically accepts high risk projects. Agree? Option C says low risk projects are favored. No, high risk projects get favored. So A and C are wrong. Everybody with me on this? Everybody getting this? Amazing. You guys are rock stars. So this is for all of you. So ideally what we are saying is this cost of capital, this number should be risk adjusted. Perhaps for this high risk project, instead of 10% as a hurdle rate, so hurdle rate here is 10%. Instead of hurdle rate of 10%, perhaps for a high risk project, the expectation of IRR should be higher or lower. It should be higher. Perhaps for this project, the expectation of IRR perhaps should have been 12%. Perhaps. For a low risk project, even a 9% would have been enough. So using this new numbers, using the new risk adjusted cost of capital, Actually, this project will get rejected and this one will get accepted. Everybody got this? So what we are saying is, you can't use the same yardstick, the same hurdle rate for all kinds of projects. If it is a riskier project, the hurdle rate should be increased. If it is a less risky, hurdle rate should be reduced. So you have to change the yardstick. You have to do a risk adjustment of the cost of capital. Okay, Vignesh Vishwanath says, I didn't get this. Vignesh, what we were doing earlier is we said we will use 10% as the cost of capital and we will compare with the IRR of the project. So naturally, the high risk project got, or let me do this. Let's say the high risk project is giving you a 10.5% return. A low risk is giving you 9.5. So Vignesh Vishwanathan, which one will you accept? High risk or low risk? You'll accept high risk, right? Because the high risk is more than 10%. So you'll simply use 10% as a normal common number. So what we are doing here is we are using 10% as one number for all the projects. What option B is telling you is perhaps for a high risk project, instead of 10%, we should expect 11%. For a low risk project, perhaps we should expect 9%. Everybody got this? So in that case, actually, this high risk project would end up getting rejected and this one will end up getting accepted. Everybody got this? So what we are saying is, instead of using the same 10% for all projects, can we use a risk adjusted cost of capital, a risk adjusted hurdle rate? Everybody got this? Amazing. You guys rock. Very nice. Okay, so let's see what we've got. Okay, so guys, look at this investment decisions, right? So I think that okay. So for this question, guys, the right answer is option B. Option D is just a distortion, right? Option D does not mean anything here. Right answer is option B, and nearly half the class got this right. So very, very good, pretty good job. Okay. Now let's look at what all do we have in section E. Section E, investment decisions, guys. Look at this. We've got capital budgeting. So in today's class, we spoke about time value of money. We looked at the capital budgeting techniques. I spoke about payback period, accounting rate of return, IRR, and NPV. Everybody good with this? We spoke about risk analysis. The last question was about the risk adjusted discount rate. So, I think we've done pretty well on this. Tomorrow morning, Uttam's going to come back and do a few more pieces on this chapter. But I hope everybody sort of got a good perspective of investment decisions. Okay, now we will move on, on section F, and this one is a section on professional ethics. Very, very important, for all management accountants, extremely important. So let's talk about this, right? As finance people, as accountants, you guys are going to be dealing with money. And guys, there is a lot of trust, the moment you're handing over your money to somebody, right? And that is where professional ethics, that's a very, very important underlying for our profession. Now, let's talk about this, right? Let's talk about ethics. So how many of you have, have been on a road, you've been driving, you've broken a rule, you've jumped a signal, you've broken a rule or anything like that. The cops have held you and you chose to open your wallet and pay the cops $100. Okay, Pathan sorted it in 50 rupees. Okay. KR says 500 rupees in Bangalore. Okay. So what do you think about this, right? You suddenly, sort of breached a signal. The cops held you, and they're asking. I mean, they can take your license and they could ask you to appear in court, or you can pay $100, 100 rupees, not dollars, 100 rupees and get away. What do you think? Is this okay? What do you think, guys? For people who have done it or who keep doing it all the time, what do you think? You caught. And the point is, if you don't pay that $100, you're going to spend 15, 20 minutes. It's going to make you wait, put up a challan. You got to go to court the next day. It will slow you down. So what do you think? 100 rupees or get the challan, go to court? Okay, somebody says run away. In that case, they'll of course catch you and put you behind bars. Okay. So, and this is where it all starts, right? This is where the challenge with ethics starts, right? And and I see people saying that okay, bribe is a better option. Think about it, right? Let's say you're running a company, and you want certain construction permits for doing a factory building, and the officer comes and it tells you, okay, hey, pay a bribe of, let's say, $10,000, let's say 7.5 lakh rupees, or if you don't pay a bribe, we will delay the permission by 6 months. And if they delay the permission by 6 months, you would, let's say, lose millions of dollars, crores and crores of rupees. What do? Pay $10,000, that's about 7 lakhs, and save 7 crores? Or what do? 7.5 lakh rupees of bribes. And guys, as a company, you can do it very smartly. Instead of paying 7.5 lakh rupees directly to that government officer, you can pay a consultant, and that consultant will take care of the officer. What do you think? You don't have to pay the bribe directly. Come on. You can get a consultant. Instead of 7.5 lakh rupees, you will pay 8 lakhs to the consultant. So consultant also makes 50,000 rupees. What do you think, guys? Come on, let's put it on the poll. 7.5 lakh rupees to save 7.5 crores. And all you need to do is pay the consultant. You're not directly giving out a bribe. You're only paying the consultant. So let's do a poll. Pay or don't pay? $7.5 lakh or 8 lakh rupees to save 8 crores. Some people are not able to take a decision. Karthikeya, you're the CFO of the company. It's yours. Okay. So majority of the class is like pay the consultant and get done with it, right? I mean, why delay the entire project by 6 months? So let's look at this, right? Let's look at an interesting thing. Walmart pays $282 million. Guys, how much is $282 million? About 2,000 crores. So Walmart pays, about 2,000 crores of penalty because there was an allegation that they violated the FCPA, the Foreign Corrupt Practices Act. Now, what the FCPA says is if you are a US issuer, you're a US company, you are not allowed to pay bribes in foreign countries to get business or to get things done. Even if you pay a few $1,000s of bribes, you will have to pay millions of dollars of penalties in the US. So look at this. Now, if I tell you that if you pay a 8 lakh rupee bribe, you can save 8 crores because your project will be expedited, but you may have to pay a fine in the US of 80 crores. What do you think? So 8 lakh rupee bribe helps you save 8 crores, but the risk is a penalty of 80 crores. Let's do this question again. And paying a consultant is the same thing. If you pay a consultant or you pay the bribe directly, same thing. $80 crore. So Logesh has a very interesting question. He would now go to the US and pay bribes there to avoid the 80 crore penalty. Amazing. Logesh, salute. I have no words. I'm speechless. Saurabh says, no, Saurabh, no clap for him. No claps. Okay. So let's look at this, right? Look at what happened to the class. The entire earlier, about 75-80% of the class says pay the consultant. Now 80% say don't pay. So guys, look at this. This is the reason why companies want to hire CMAs, right? Why companies want to hire CPAs who understand this exposure, right? Who really understand the exposure here, that a few $1,000s of bribes could lead to millions of dollars of penalties. Everybody with me on this? So of course, it doesn't make any sense to pay the bribes. Right? Walmart, look at this. They paid $282 million to settle allegations that they violated the FCPA by paying an intermediary in Brazil for help in obtaining construction permits and having weak anti-corruption internal controls in Brazil, China, India, and Mexico. Everybody with me on this? Now, Kailash has a very interesting point. What if Kailash pays the bribe and nobody knows? Kailash, what if you pay the bribe and everybody knows? What if there is a whistleblower in your company? What if information goes out? You would lose your job. Your company would lose credibility. There would be a lawsuit against your company. You would have to pay millions of dollars of penalties. Kailash, do you still want to pay the bribe? Abhishek says pay the whistleblower also. So some guys, nobody can beat you. You can only work in Indian companies. But if you are looking at career opportunities with multinational companies, the answer is don't pay. Everybody with me on this? And please, when you come for placements, please inform the placement team, okay, get me a job with an Indian company. I want to do whatever I want. But if you want to work with a multinational company, the answer is don't pay. So guys, the point is, this is real serious business. So guys, have you heard of this company called Mondelez? This is the parent company for Cadbury's. Now, Mondelez has a plant in Baddi in Himachal Pradesh, and there were allegations that the Baddi plant paid a few $1,000s of bribes to get things done. They had to pay, Mondelez had to pay millions of dollars of penalties in the US to settle this. This is real serious business. Companies like Oracle, like Cognizant, they have been stuck in FCPA violation. So it's a real big deal. Everybody gets this? KR, penalties would be paid by the US entity. So now what do you think of ethics, guys? Do you want to learn ethics or can we call it a day? Look at this, right? Amazing, right? Now the class wants to learn ethics. You know, typically when you pick up ethics, people think of the moral science classes that they had in school and nobody's interested. Amazing. Okay. So let's see what we're going to have in ethics, right? So when we talk about professional ethics, first we'll talk about business ethics. Then we will talk about ethical considerations for management, accounting, and financial management professionals. This is ethical considerations for all of you. Then we have ethical considerations for the organization. Everybody clear? So Venkatesh has an interesting question. If foreign companies need to follow ethics in India, wouldn't it be difficult? Venkatesh, that is why these foreign companies, they hire CMAs and CPAs who understand the importance of ethics. Right? That's your opportunity. That's why I'm teaching you ethics. Okay, now let us go a little philosophical with ethics, right? Let's go a little philosophical, right? Look at this question, right? Can ethics be learned? That's why I'm teaching you ethics. Let's get a little philosophical. Look at what we have here. Moral philosophy. Can you see this teleology? So these are various moral philosophies, right? Saswat, if a CMA bribes someone, the CMA would lose the CMA certificate, lose the CMA license. I see a question from Girish. Ethics can be different for different countries. Girish, we'll talk about this. The moral philosophy around relativism. We'll talk about that. What do you mean by teleology? Teleology means target. Teleology means your end goal should be good. Now, when I think of teleology, it sort of reminds me of Lord Krishna. Now, what Lord Krishna says. So guys, Pratyusha is the class monitor, and is like really upset that you guys are not focusing on the class. So guys, please focus. Okay, let's have a round of applause for Pratyusha. Okay, great, good. So guys, back here, let's focus. Okay, so now when you talk about teleology, right, it sort of reminds me of Lord Krishna. What he said is your ultimate goal should be correct. He went as far as saying that for a good purpose, if you say a lie, it is equal to 100 truths. You guys have heard of this? So for a good purpose, if you have to say a lie, that is equal to 100 truths. As long as your purpose is good, as long as your target is good. That sort of sounds like the moral philosophy of teleology. But when we talk about, let's say, Lord Ram, again, from Hindu mythology, right? Lord Ram, he's called, in Hindi, he's called Maryada Purushottam Ram, right? So, he's very duty bound. He will never do anything which is wrong. that sort of sounds like deontology. Everybody with me on this? Right? So the various moral philosophies, and then there is, virtue ethics. Again, it's like deontology only. Utilitarianism, it's again like teleology only. Now I'm going to move on. Let's talk about relativism, right? This is basically, what we're saying is moral values change throughout time and throughout the world. If you realize, Lord Rama was there in Satyug, and then came Kali Yuga. So again, these are changes. So ethics, morality changes across time. Morality changes as you go in different parts of the world, right? So let's say in India, a lot of you think that paying a bribe to a cop is okay. Try that in the US. So I remember, I was once driving in the US, and of course, you love the roads and you don't care about the speed limits sometimes, right? You love the accelerator and you're enjoying it. You've never driven in a road like that. So you go full-fledged. And then, and then I had the cops following me. They made me stop. And I of course, received a ticket. I had to pay $350 to settle that. And I had to pay that in court. Right? So imagine speeding ticket, and I paid literally 25,000 rupees. So do you think next time I'm going to break rules again? I mean, I could have taken out like a $10 and given to the cop. He wouldn't have taken that, right? So the point is, right, ethics sometimes gets relative. But what you really need to understand is you need to have the highest ethical standards as a CMA, right? Highest ethical standards. Typically in the US, right, it's a very litigative society, right? And that is where nobody tries to play the fool. If you play the fool, you'll be taken to the court and, you'd be in a very, very bad place. In India, or rather in all developing countries, talk about India, talk about China, talk about Brazil, talk about Mexico, people talk like Upendra. Rules are made to be broken. Right? If you start talking like that, thinking like that, that is where the problems start. Everybody with me? Right? So, and that is where we'll talk about ethical decision making. We'll talk about fairness, integrity, due diligence, your fiduciary responsibility. Now I'm going to move on and look at all the IMA's ethical principles, right? Honesty, fairness, objectivity, and responsibility. Let's talk a little bit around fraud, right? So let's talk about fraud. So what do you mean by fraud? What do you mean by fraud? So a fraud could be lying is a fraud. If you're telling a lie, it's a fraud. Stealing is a fraud. Cheating is a fraud. Everybody with me on this? Think about it, right? Let us say you've made profits of $10 million. Or let's reverse. Let's say you've made a loss of $5 million. And you're reporting a profit of 10 million. Is that a fraud? It is lying. Right? You're stealing cash from the company. You're stealing assets from the company. Stealing. You're evading taxes. You're paying bribes. Cheating. Anyways, the challenge is, how do you get to the bottom of fraud, right? How do you understand whether fraud can happen or fraud has happened? I'm going to give you an amazing formula to get to the bottom of fraud. Now, I'm going to introduce all you guys to the fraud risk triangle. Now, on the fraud risk triangle, we're going to have three ends. A triangle has three ends. And here we will, let's say on one end, we have incentive or pressure. Here we have opportunity. And here we have rationalization. So let's talk about this. Let's say you are a CEO in the company which has made a loss of $5 million. And because you have made a loss this year, there is a high chance you may get fired. Of course, you will not get any bonuses and you may get fired. Let me ask you, is there an incentive? Is there a pressure on you to do a fraud? Yes, very high. Right? So if you are able to overstate revenues, and let's say you overstate revenues and by $15 million in such a way that a loss of 5 million becomes a profit of 10 million. Your job is safe, you also get a bonus. The question is, as the CEO, as the founder, do you have the opportunity? Yes, you have the opportunity. Everybody worships you. Everybody worships you like God. Like, they will do, the accounts team will do whatever you ask them to do. So there is a high incentive or pressure on you to do a fraud. There is an opportunity for you to do the fraud. But let us say you are a man of ethics. You're a person of ethics. You decide you're not able to rationalize this fraud. You decide that you're okay getting fired rather than doing a fraud. Let me ask you, will fraud happen? No, because there was incentive, there was pressure, there was opportunity, but there was no rationalization. Fraud did not happen. Everybody with me on this? But if you were like Ramalingam Raju, you were able to rationalize, you lack ethics, fraud would have happened. Everybody with me on that? So Ramalingam Raju had incentive or pressure to do fraud. He had an opportunity and he was able to rationalize. He was like, it's my company, I will do whatever I want. Everybody clear? Okay, let's take another example. How many married men in the class? Okay. So let's say, your wife tells you that unless you get me a 6-carat stone for the finger, she's not going to talk to you. Until you get that piece, you're supposed to sleep down on the floor, that too in the living room. And you have a deadline that if you don't get it in the next 6 months, you have to sleep outside on the stairs. What do you do? And you're a financial controller. High pressure on you. You love your wife. She's unreasonable, but you still love her. I mean, let me put it this way. You don't have an option. You have very, very high pressure from home to do a fraud, to steal from the company. You have an opportunity to steal from the company. And then you say, okay, hey, I've worked in this company for the last 15 years. And the company only pays me a humble salary So much so that I'm not even able to afford a diamond piece for my wife. So you decide to steal from the company. Let me ask you this question. Will fraud happen? So look at this. For fraud to happen, all these three pieces need to come together. Everybody sort of gets a perspective of the fraud risk triangle. And some people are deciding not to get married, but it's okay. I mean, it's just about a diamond ring. And, once you become a CMA, you'd be ethically able to earn all that money. Don't worry. Okay, let's have a round of applause for everyone. Okay, so now guys, so this is typically about the piece around fraud and fraud risk triangle. One of the things that we say, when we talk about from an organization perspective, when we talk about ethics in an organization, it starts from the top. What that means is that if the top leaders are not ethical, there is no way you will have the DNA of ethics in an organization. Think about it, right, guys? Let's say, again, you need some permissions from the government, and the CEO, tells you, okay, hey, pay the bribe and get it done. Do you think you're going to have the right culture of ethics in the organization? Of course not. So ethics starts at the top, right? Let's talk about of course, as you go through your book, right, you'll have a lot of pieces around ethics that we will cover. Have you guys heard of the Sarbanes-Oxley Act of 2002? So this goes back, and we'll talk about this, and when we do part 1, section E, which is internal controls. But let's talk about this very briefly, right? So it goes back to the year 2001, where you had this company called Enron, one of the largest energy companies in the US. Now, what Enron did back then is created a bunch of financial statements, where they overstated revenues, right? So tomorrow's revenues, they recognized today, right? Actually, let me see. There's actually a very good video that I have on Enron. It was one of the accountant diaries that I had created long back. So let me do this. Enron was one of the largest energy companies in the US back in 2001. But Enron's management played the fool with their financial statements.
Guilty verdicts in the biggest case of corporate fraud in history. 38 counts of fraud and conspiracy.
Lawyers for Jeffrey Skilling and Kenneth Lay threw around complicated notions about margins.
They inflated revenues to paint a flowery picture in front of their investors.
Enron Online will change the markets. It is real simple. You turn on your computer and it's right there. That's our vision. We're trying to change the world.
They did mark-to-market accounting, which was not allowed as per GAAP. Enron had a lot of debt on their balance sheet. Now, do investors like debt? No. So Enron said, let's not show it to them. Enron created many special purpose vehicles to hide that debt from Enron's balance sheet. Basically, Enron's management committed an accounting fraud. And naturally, when this came out, Enron was forced to file for bankruptcy.
Instructed by my counsel not to testify. Enron is a company, deals with everyone with absolute integrity. We play by...
The problem didn't end there. The auditors of Enron were Arthur Andersen, which was one of the big 5 back then. So today you have the big 4. Back in 2001, it was the big 5. And Arthur Andersen was amongst the biggest of the big 5. And Arthur Andersen expressed a clean, unqualified opinion on Enron's fraudulent financial statements. So when Enron's fraud came out, the question to Arthur Andersen was, how come you guys didn't notice?
A Houston jury convicted Arthur Andersen of obstruction of justice and its role in the collapse of Enron. Andersen has already lost more than a third of its clients, and today's verdict could put the embattled Andersen out of business.
Things went so bad that Arthur Andersen was asked to surrender its CPA license in the US, and the Big Five became Big Four.
People that made some wrong decisions, and it's just unfortunate that everyone has to suffer.
Enron goes out of business, Arthur Andersen shuts shop, and investors press the panic button.
The stock market is now down 20%.
It is in the wake of all this panic that the US Congress enacts the Sarbanes-Oxley Act in 2002, or as we call it, SOX. A lot of provisions in SOX were learnings that the US senators had from the Enron scandal. For instance, when Enron's CEO was investigated as to how come there was no internal controls at Enron, he replied that he was the CEO of the company, and how would he know about internal controls? It was not his job. So SOX made it clear that management is not just responsible for the financials, they are also responsible for their internal controls. SOX also created the PCAOB, that's the Public Company Accounting Oversight Board, whose job is to regulate the auditors of issuers or public companies. And after SOX, the auditors of issuers are now required to do two audits and express two opinions. Number one on the financial statements, and number two on internal controls over financial reporting. Now, both these audits go hand in hand, and that's why we call this an integrated audit. All US issuers and their subsidiaries around the world are required to comply with US regulations, including SOX or FCPA, that's the Foreign Corrupt Practices Act. Let's say subsidiaries of US companies like Amazon or Google or Coca-Cola in India follow Ind AS. But ultimately, all these financial statements need to get converted to US GAAP for consolidation with the US parent. The list of US issuers also includes Indian companies like Tata Motors, ICICI, HDFC Bank, Infosys, Wipro, Dr. Reddy's Labs. Now, these companies are listed in India and accountable to SEBI. But since they've also raised money from the US, they are also accountable to the US SEC, the US Securities and Exchange Commission, and they have to comply with the US federal securities laws. So guys, you now understand why all of the Big Four and multinational companies recruit thousands of Miles CPA alumni every year. Okay, so guys, and again, good perspective on what happened with Enron and Arthur Andersen back in 2001, the Sarbanes-Oxley Act getting enacted. We will, of course, cover SOX in a lot of detail when we do part 1, section E, which is internal controls. But again, in this section F, again, you need to understand, what SOX did, when did SOX come? So I'll give you how SOX changed the entire mindset in corporate America. Think about it, right? Let me give you an example. Let us say there is a sign there on the wall which says, "Don't litter." Would you agree that people will still litter? Some people won't, but many will still litter, right? Who cares about the sign? What SOX did is SOX changed that sign. Don't litter, fine $5 million. Would you ever dare to litter? So everybody gets what SOX did, right? It sort of made sure the penalties are pronounced for every count of secure. So SOX is a Federal Securities Act, right? for every count of, every violation of SOX is a violation of the securities laws. There is, of course, millions of dollars of penalties and mandatory jail time. That means for all the gentlemen, any securities fraud, be prepared to be somebody's girlfriend in jail. Real serious business. Everybody gets this, right? Very, very important, right? Ethics is extremely, extremely important, for organizations, for individuals, for everyone, and nobody gets away with this. Okay, so let's so guys, that's sort of a top level view on ethics, and of course you can go to the portions for a lot more details. Now I'm going to talk about a couple of more pieces around ethics. One of the pieces, this is a new piece added on the CMA exams. This is around sustainability and social responsibility. So let me show this to you on the book. So look at this. There's a Carroll CSR pyramid, right? And on this pyramid, it talks about the responsibility of the organization. Look at the base of the pyramid. The base of the pyramid is economic responsibility. What does that mean? That if you are a for-profit corporation, you need to make money. You have an economic responsibility to your shareholders. Everybody with me on that? But at the same time, you also have a legal responsibility to comply with laws and regulations. You have an ethical responsibility. You need to be, working with ethics in good faith. And then you have a philanthropic responsibility to give back to the society. Everybody with me on this? The base is still economic responsibility. If you don't make money, there is no way that your entire purpose is defeated. But you need to make money. You need to comply with laws and regulations. You need to be ethical, and sometimes, right? You need to understand the spirit of the law. You need to act in good faith. You may comply with the letter of the law. Legally, you're fine, but you're deceiving your suppliers, deceiving people you work with, right? That is unethical. And the last one, of course, is on the top is philanthropic responsibility around CSR, corporate social responsibility. Everybody gets this? Let me put it up in a different way, right? So can we say one of the important agendas for you as a business is to make profit? Profit is important for you, right? You need to focus on profits. You also need to focus on people. As an organization, you can't be fooling people, right? You also need to be focusing on people. You have a social responsibility as well, right? Society, people in general, right? So profit is important, very important, but you also need to care about the people, and you also need to care about the planet. That's the environment. Now let's talk about this. Let's say you're a company which cares only about profits. You are here. You care only about profits. You care a damn about people. You care a damn about the planet. Sorry. Okay, I think I didn't share the board. Okay, so here is what you have, guys. People, profit, planet. So you're a company which only cares about profits. You're in this part. You don't care about people. You don't care about the planet. You're doing pollution. You do nothing for the society. Do you think this organization is a sustainable organization? One day you will be shut down. So let's say, you have a cigarette factory. Or let's say, you're doing drugs. You care about profit. You care a damn about people. You care a damn about environment. It is a non-sustainable organization. Everybody agrees with that? So if you talk about business sustainability, unless you have all three, it is missing. Or let's say you're an organization which cares about profit, which cares about people. So let us say you are somewhere in this zone. You care about profit and you also care about the society. You do CSR and all of that. But your factories generate a lot of pollution. Do you think you're a sustainable organization? So basically what we are saying is, if you want to be a sustainable organization, you have to target coming in the center here. This is the part, let me color it green, right? This is the part where you have business sustainability. These are the organizations which care about profit, people, and the planet, all the three P's. We often call it the triple bottom line. So don't look at bottom line only in profit. Look at bottom line in terms of what you're doing for the society, what you're doing for the environment. And this is where you should be if you want to build up a sustainable organization, if you want to build up a sustainable business. Everybody with me on this? Typically, guys, when we look at financial statements, what do we measure? On the financials, what do we measure? Profit, right? We only measure the financial profit, the economic profit, the money that you've made. That is where, when we do part 1, section A, we will also talk about integrated reporting. Now, what you do in an integrated reporting is, it is not mandatory right now, it is optional for companies. In integrated reporting, you basically do a holistic report in terms of how the organization is committed to the society, what value it is adding to the society, how the organization is committed to the environment, right? So the point is, you have a holistic perspective of not just profit, but also how the organization takes care of people and the planet. So I know that the focus is in a big way on profits, right? This is often the biggest focus, profits. But if you want to build up a sustainable organization, you also need to take care of people. You also need to take care of the planet. You need to focus on all the three P's. It's called the triple bottom line. Everybody clear? Amazing, amazing. You guys get it all. So guys, that's about all we have for today. And Pratyusha, the class monitor, very happy, right? She's like, it's fully clear. It's clear, pura. It's absolutely clear. So guys, I think the agenda for me on my classes is to get you started, right? That's my biggest agenda, to help you build the momentum, to make sure you start liking the topics, right? I'm sure all of you now love investment decisions. Yeah, you want to learn ethics, because if you don't know ethics, you won't land anywhere. I think with this, we're done with the last class from my side on part 2. Of course, I'm going to see a lot of you on back on section A. Back on part 1. Of course, everybody knows their homework, right? So you have the LMS access where you have all the videos and everything. So guys, before tomorrow morning's class, how about you watch? So this is part 2. Sorry, part 2, section E. So look at this. You have about about 1.5 hours of video on capital budgeting, another 16 minutes here. So less than 2 hours of videos on capital budgeting. And on ethics, I think you have small videos like 15 minutes. Here you have 20 minutes, 35, and another 12 minutes, so 45. So you have about 2.5 hours of videos to watch. So guys, that's the miles flexing for you today evening before you come to class tomorrow morning, where Uttam would recap on capital budgeting. He would run you through a lot more questions. And then, of course, you have a lot of practice sessions which are going to be upcoming in the next week. So you have a session on Monday morning, so 1 second. So, right. So you have, this is the, this is a session on tomorrow morning. Then you have a session tomorrow evening, and then I think you have a session on Monday, Wednesday, Friday. Is that how it runs for you guys? Yep, then you have Monday, and then you have Wednesday, and you have Friday. So guys, you can figure this out. It's all there in the upcoming sessions. You can simply click on register now, get registered for the sessions. Section E, Section F, both of these are very high scoring sections. So there is no point leaving this out. And I see a question from Ansi Abraham that will we have a revision session? So guys, we keep on having sessions, we keep on doing a lot of sessions, but what I would suggest is for the month of November, December, and January, right? What you guys need to do is do a lot of practice on your Wiley online test bank. You complete the entire Wiley online access. The Miles access only has a very few questions. I think you have about 300 to 400 MCQs in the Miles access. Wiley has over 2,000. So a lot of practice that you need to do. And with the MCQs that I had on today's class, everybody understands, right? That even if you understand the concepts, unless you do practice, you are not going to be ready for the exams. Everybody agrees with that? The mantra, guys, let me tell you, even if you attend my classes, even if you watch the videos 5 times, if you don't do practice and go for the exam, high chance you may not pass. Right? The entire concept class that I do, the videos, they are 25% of the entire game. The remaining 75% is practice, practice, practice. Everybody with me on this? Because no matter how much of concepts are very important. They're very important starting point. That's why I do them. But the real mantra to pass the CMA exams is practice. So, concepts are to get you started, and then practice, practice. So a lot of, and somebody said there are 1,600 MCQs on the Wiley online access. So you have about 400 MCQs on the Miles online access. So I'm sure if you've completed that, you want to complete that in the next week. And then another 1,600 MCQs on the Wiley online access. And the mantra is a lot of practice, right? Mantra is a lot of practice. So I see, Manmeet saying Miles is tough. Manmeet, we have only picked up a sample MCQs, right? Even in today's class, I gave you 3 MCQs. How many of you would say it was tough? Remember the first MCQ on a multi-period project having a positive NPV? I think that was the simplest question possible. Yet 80% of you got it wrong. So the point is, guys, the mantra, a lot of questions, they may look tough, but the moment you try to answer them, you try to understand with the answer explanations, go back to your concept books, everything will add up. Everybody agrees on that? Somebody says, how do I remember so many formulas? Guys, I never give you formulas to remember. For every formula, I have broken it down. And even if you don't remember the formula, you can make the formula in the exam center. Right? If it was a turnover ratio, what did I tell you? Turn it over, right? For everything, there are aids for you. So they're hardly formulas. It's just about concepts, right? Understand the concept, understand the larger picture, and then a lot of practice. Okay, Saksham has a very interesting question. Is Wiley and Miles enough to clear? Saksham, the response is more than enough. And I'm sure you're asking this question because you have not done it. By the time you would be done with this, you'll be like, okay, I've done so much. I now want to go for my exam. Okay. Now the point is, guys, that the classes are over, right? There is a risk. The risk is losing the momentum, right? In the next 1 week, the classes are going to be over. The risk is a lot of you guys will lose the momentum. That means in the class, when you have the classes happening, you have momentum. Now this is a real test of your commitment. Right? It's a real test of your commitment over the next 2 to 3 months. It is not that the Miles team is going to disappear. Over the next 3 months, November, December, January, you may not have classes for part 2, but the entire Miles team is available for you one-on-one, right? Let's say when you look at the classes, right? When you look at the classes, it is always a one-to-many. I'm doing a class and there are hundreds of people in the class, right? All the classes are one-to-many. But when you do, when you have any doubts, the way out for you is to use the one-on-one mentoring. Let's say you have doubts on CMA part 2. Just select one of the mentors, book up a mentoring slot, and you have a crazy number of mentoring slots. Book up a slot and 15-minute slot or a 30-minute slot. You can book up to 100 slots, 115-minute slots, but we are very, very flexible. We don't restrict you even beyond that. So the point is the one-on-one mentoring session would give you the one-on-one feel. So you have a doubt, you have a worry, you're anxious. So the only people who book the one-on-one mentoring slot are the serious people. Right? So only people who book the one-on-one slots are the serious people, right? If you don't do your homework, you will not have a doubt, right? If you're not practicing, if you're not, on the momentum, you will get lost. So guys, you didn't join Miles to attend my classes, right? You didn't join Miles to attend a few practice sessions. You didn't join Miles to earn LMS access, right? You joined Miles to become a CMA. And you really have to commit. And people think commitment is money. Guys, the money that you're paying is peanuts, right? 1.5 lakhs for CMA, that is nothing. The commitment that we really expect from you is your hours and your time. That is the biggest commitment. And unless you give us, put that commitment in, there is no way you're going to pass the exam, right? There is no way you can buy a CMA qualification, right? You'll have to earn it. So guys, with this, I wish all of you all the best. Soham says, how many hours of study? About 20 hours of study every week is what we expect, 20 to 25 hours. I wish all of you all the best. Do really well. Practice hard. I sort of missed introducing the panelists early on in the session. But guys, I'm sure you guys have met Nitya, Pallavi, Anaga. So, I'll quickly let them say hi to all of you and wish all of you good luck. So, hi Nitya, hi Pallavi, hi Anaga.
Hey Varun, hope everyone can see me.
Yes.
Okay. So yeah, I missed to welcome you, but then that was a good closing remark that you gave me. So thanks for having me on the panel, and I've been interacting with all of you over the Q&A. So today is the concluding part. So if you've been following the instructions and homework from Varun, you should be in a great shape for Jan-Feb window. But then you can straight away move to revision while OTB and mock test. But if not, do not panic and do not lose focus also. This is the time to buckle up and watch the recorded webinars and fall back in line. So as Varun mentioned, we have a lot of resources and I have capable mentors to help you throughout and guide you till the exams. So good luck guys and wish you a happy Diwali.
Hey Nitya, thank you. So good afternoon everyone, or rather I should say good evening everyone. So I hope you guys enjoyed the sessions, and you all know this was the last session for part 2, and soon after we'll be starting with part 1. So yeah, we are, fingers crossed, we are hoping for live offline sessions now. And for folks who are looking at Jan-Feb window for their part 2 examination or even for part 1 examination, you've got the best time now in order to revise, in order to reach out to us for any mentoring session. I'm sure many people reach out to me and all other mentors over here for mentoring sessions, and we have huge demand over here. So yes, Varun, we are seriously flooded, and it's really heartening to know that so many people are interested in booking mentoring sessions, and it's feels really good to be able to answer all their queries. So with that, guys, I'll let you all guys go and enjoy the rest of your Saturday and have a great Diwali. May this Diwali be the best of all your Diwalis till now and the coming Diwalis as well. So enjoy Diwali and study harder. So that is my mantra. So enjoy the vacations, plus with the vacations, keep studying, keep the momentum on. So over to you, Varun. Anaga, are you there?
Yeah, thank you, Pallavi. So as Varun mentioned, so do a lot of practice of the MCQs as well as essays. Go through all the videos and the books which are being provided to you. Book mentoring session. If you have any doubt, get it cleared. And also ensure that you appear for the mock test which are there. So you will get an idea exactly how well prepared you are to appear for the exam. And wish you all a very happy Diwali and all the best for your exams. Over to you, Varun.
So I see, a message in the chat. Nitya, there seem to be a lot of fans of Devendra in the chat box. Vignesh has pasted the same message, I think, 15 times. See what can be done. So guys, Devendra is a very senior working professional. So it's not that he can take out crazy time, but we can of course request him for a few additional session. And then somebody says Uttam sir rock. So guys, see, the agenda is right. We try to have an entire mix of faculty members for you. So So I do a session, and then Uttam comes, and then Devendra comes, and then you have a few other faculty. Anaka takes a few sessions for students. So I think we sort of divide and conquer. I think all of us have their own strength, have our own strengths, and have our own style, and we try to sort of expose you to everyone. Of course, feedback taken. We will see if we can increase the number of sessions from Devendra. Absolutely. Okay, now before we call it a day, guys, a quick, exam tip, for you. The CMA is a 4-hour exam. Typically, you have you have 100 multiple choice questions, 2 essay questions, right? So you have up to 3 hours for you to do the MCQs. When I say up to 3 hours, that means the moment you are done with 3 hours, MCQs will stop. That means in 3 hours, if you're able to do only 90 MCQs, it will stop and you will not be able to do MCQs any further. And the last hour will be for essays. However, if you're able to complete the MCQs in less than 3 hours, let's say you're able to complete the MCQs in 2 hours, 50 minutes or 2 hours, 45 minutes, the 10 or 15 minutes that you save will get added to your essay time. Everybody got this? So up to 3 hours for MCQs and 1 hour for your essays. So typically my recommendation is you should target to complete the MCQs in about 2 hours, 40 minutes or 2 hours, 45 minutes, right? 100 MCQs are doable in that time. So I'm talking about, 160 minutes or so, 160, 165 minutes for you to complete all your MCQs. So that, for your essays, instead of 1 hour, you actually get a 1 hour plus a few minutes, right? So essays take a little bit time. Having said that, one of the warnings that I will have for all of you, for your essays is do not try to write too much. I remember when I gave my CMA exams many years back, I did the same mistake. So I went for CMA Part 1 exam first, and I took the entire 3 hours for the MCQs. The last 1 hour is where I spent for the essays. And I got an essay where I knew everything about it. And I wrote a lot in my first essay, so much so that I hardly had any time for my second essay. I had to actually skip a few of the questions on the second essay. I was able to score a 420 out of 500 on Part 1. And of course, I was very disappointed when I came out of the exam center. So what I did is when I went for my Part 2 exam, I made it a point. My target was to complete the MCQs in 2.5 hours, which was very aggressive. But I think I was able to complete it in about 2 hours, 45 minutes. I saved about 15 minutes from MCQs, and I got about an hour, 15 minutes for the essays. And I wrote the 2 essays properly. I got a 480 on my Part 2, right? So the point is, you would need time for essays, but do not try to write stories, right? Do not try to write stories. Typically, right, at that point, I went in with an Indian mindset, to be very honest, right? The mindset was, if you write more, you get more marks. If you write less, you get less marks, right? So if it's an essay question, you're supposed to write more, right? That was the mindset, I went with. But over the years, as we have spoken to the IMA, what we realize is they actually reward you for brevity. They want you to be brief. So you have to keep it short and sweet. Do not try to write stories, right? So keep that in mind. And as long as you're writing to the point, you will get full marks. The essay portion on the CMA exam is human graded, and the human graders are very lenient. The only thing that they have is if you leave it blank, they can't give you any score. So you have to write something and something relevant, they will give you full marks. So for essays, just make sure that you are keeping it very, very brief. Now, I know, a lot of you, you've sort of passed through the Indian education system. So if you know a lot, you want to write a lot. So when you're with essays, my recommendation is complete all the pieces, right? Each essay has 5 or 6 small pieces. Complete all the pieces and then come back and try to write stories if you want to write stories. But first, complete everything, right? The basic requirement for all the answers, do not leave any unattempted ones. Everybody gets this? So out of 500 points that you have 75%, which is 375 marks for your MCQs, 125 marks for your essays. Total of 500, you got to score a 360 to pass. So Manmeet, yes, I got an international rank. I got a certificate of distinguished performance. I was fourth globally during that period. But if I had done a good job in my part one, I would have been one of the top three. So we've also had alumni in Miles who've been among the top three rankers in the past. But guys, anyways, that is not the focus. The agenda here is not to make you a ranker. Rank or no rank doesn't matter as long as you pass the CMA exams, as long as you score a 360 on both the parts. Guys, as I said, the mantra once again is practice, practice, practice. So Miles Flexing will give you a start. My classes, Uttam's classes, the agenda is to get your concepts right, and then a lot of practice. So for guys who have a backlog in part 2, section A, B, C, D, what I will advise you is over the next 7 days, focus on E and F, complete E and F, and then come back to ABC. Everybody okay with that? And everybody agrees that E and F is very exciting, right? And B is a little long one. A was interesting, short and sweet. C was also fine. Decision analysis was also fine. D was also okay. I think B was a little bit of a long one. So you can keep B to the last, do E and F, then do A, C, and D, and then B can come at the end, no problem, right? So guys, any order is fine, right? It's just about what makes you feel good. Some people want to tackle the monster first, right? Give me the most difficult one first. Some people like me want to get done with the easy pieces and then, get to the monster. But in any case, I think, part 2 is pretty easy. A lot of people ask me about part 1 versus part 2. Between part 1 and part 2, let me tell you that part 1 is lengthier than part 2, and part 1 has a slightly lesser pass rate than part 2 as well, right? So part 2 is a good place to start, you can do part 2 and then come back for part 1. Narendra Kumar says, tips for working professionals. Guys, one important tip that I'll have for everyone here, working professional or student, study every day. Right, that's my tip. So if you think you have a very busy day in office, you've had a 12-hour work day, I'm okay if you spend only 30 minutes on your studies, right? But make sure you're spending some time every day. The biggest worry, guys, the biggest worry is losing momentum. That's the biggest worry. In a few days, you will not study. You would have lost the momentum. For you to come back to studies would become a big deal. People agree with what I'm saying? Do not lose momentum. I'm okay. Monday to Friday, 30 minutes per day, an hour per day, fine. Saturday, Sunday, extra hours, right? So if you're married, talk to your husband, talk to your wife, right? Tell them, okay, here, this is your commitment. If you're not married, of course, you're going to meet your girlfriend or meet your boyfriend and tell them, okay, hey, this really means a lot to you. And, you really have committed to CPA. Your work-life balance is now a work-study balance, right? Patan says, what if they have kids? Okay, so for those who have kids, study with your kids, right? And I have a lot of parents who are alumni. What they do is they open up their books, they get the kids to study with them. It works wonders. The kids are really motivated, saying, okay, Papa is studying or Mommy is studying, and they do really well, and you become an inspiration, right? If you're a dad, you become a hero. If you're a mom, you become a hero, for your kids. So if you have kids, study with them. If you have spouses, I'm sure they'll understand, guys. Come on, if you're a husband, tell your wife you're gonna get that 6 carats once you're a CMA. If you're a wife, I'm sure your husband will understand. Tell him to watch some soccer or cricket or go out with his friends or watch some movies. He'll be fine. So I think you guys know the dynamics, how to sort the husbands and wives. And for those who are not married, I'm sure you will figure it out. Thank you so much, everyone. I had a great run with you over the last 5 weeks. Really looking forward to your CMA. I had a great fun with all of you. And I really look forward to all of you passing your part 2 exams. And for those who have not attended part 1 classes, I look forward to seeing you when we do part 1. I think for most of you would be starting in the month of February. So all the best. I wish you a very, very happy festive season ahead. Happy Diwali in advance. But guys, this Diwali, this festive season, you've committed to your CMA, and guys, this is going to go very long way. Those 3 letters after your name are going to be very, very valuable. So thank you so much. Bye-bye, everyone. Thanks, Nitya, Pallavi, and I think round of applause. I'm going to unmute everyone now. Let's have a huge round of applause, guys. Come on. Yes, now. Amazing. So thank you so much. Bye-bye, guys. Bye. Bye.
Thank you so
Bye,
much.
Varun.
Thank you, Varun.